Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, Senior Analyst. So thankful and so glad you joined us for this week's edition of our Market Carver for December 12th, 2024, as we race towards the Christmas season. Hope you're having a great one. This week, we've got a few topics for you, all underneath the valuation umbrella. So that's kind of Zach and I's neighborhood of the investment universe, while we have Andrew primarily responsible for the technical investment side of the equation. So today we'll kind of hit the fundamentals. We'll talk about the Buffett Indicator. Zach will unpack that for you and what that means. I'll take a look at small caps and what they're showing us opportunity-wise, and then we'll turn our eyes globally and see what we see there. So Zach, I will tee it up to you to start and go over the Buffett Indicator.
Yeah, so as Adam mentioned, valuations are something, particularly from he and I's seat, that we spend a lot of time looking at. In the large cap equity part of the large cap domestic equity part of the market right now, what we've seen is valuations have really expanded. There are a lot of different metrics that you can use to evaluate valuation, how expensive, cheap something might be. The Buffett Indicator is one such way, and really it looks at it from a 30,000-foot view. So the Buffett Indicator shown on the chart here is the aggregate U.S. market cap divided by the nation's GDP. If you've listened to us for a while, you might say, well, markets and the economy are different. So why have an indicator that connects the two? It's a valid point. They are different, but there is still a relation between the two, particularly the GDP and general market growth. A strong market tends to be underpinned by strong economic growth, by strong GDP. And so that's the reason for the relation there. And what you can see, we're really at a historic moment in terms of the ratio here, as the aggregate U.S. market cap, for the first time in history, is now more than double the nation's GDP. And what that tells us, along with many other indicators, is that the market is pretty expensive right now. Certainly no coincidence that news headlines are capturing Warren Buffett being on a record level of cash. Comments I've seen from him are that cash tends to be a more attractive investment from a value opportunity right now than some of the large cap equities. We're on the back of, 2 weeks from now, on the back of the S&P 500 closing its second consecutive 20+% year. And a lot of that has been driven by those large cap names that many of you are familiar with. Amazon, Nvidia, Apple, etc. Does not mean that there are not opportunities in the market. And Adam's going to cover that next.
Yeah, great. Thanks, Zach. And I think that is an illustrative point and one to be worth paying attention to, but just can't hardly say enough how important it is to understand how much of our market cap is tied up in the hands of a few mega-sized companies, one of which is Berkshire Hathaway. And this is just speculation on my part, but I think one of the reasons he has so much cash accumulated, yes, he sees expensive large cap companies, but when you're looking at the percentage of cash they have on their balance sheet, you're talking about several $100 billion worth of cash. So they can't necessarily go and deploy that into the plethora of opportunities that are in smaller size company, be them publicly traded or privately traded, when you can't really deploy that $1 or $2 billion or even 10 at a time and really move the needle in terms of their earnings. They are using his words, hunting elephants, and they find the elephants very expensive. So drilling in to those small company premiums and those differences. So even though we see a lot of expensiveness on the larger cap side, we do see some opportunities in small caps. Now, we don't want to just blindly go out and buy small caps, but I think this speaks to the opportunity that could be ahead of us. What we're looking at is a scatter plot chart. Along the x-axis, what we're looking at are periods of time measuring the relationship for how expensive large caps are relative to small caps. And then vertically on the y-axis, we're plotting that against the 5-year forward return. So obviously the data stops 5 years ago until they can add the last 5 years worth of data to these last 5 years of points. And what you find is a steeply negative correlation, meaning the more times you see large caps richly priced relative to small caps, the lower their future returns are. And conversely, for what we see today, where small caps are disproportionately cheaper relative to large caps turns out to be a positive opportunity going forward. Just how positive? Over 90% of the time, where we see valuations at this much of a gap, small cap versus large cap, 90% of the time, we see positive forward returns relative to large cap. So we have to keep that in mind. And furthermore, 51% of those saw an annualized return advantage of 10% per year. So we're not talking about just small numbers around the margin. Now, one last point to this, if you've paid attention to us in the Thirdly or followed us on the Market Carver or even within your family updates, one thing we really have to take into account is how this current era's market is different because of how many companies have been able to stay private. So these opportunities may not, and that's why I say we can't just go out and blindly buy small caps. A lot of the companies that would typically outperform are still in the hands of private investors. And that is the way we have spent a lot of energy at F&G figuring out how to get you correctly positioned for that opportunity. So last point here is we'll take a look globally. And then Zach mentioned a 30,000 foot view. That would clearly be what we're looking at here. But I think it's really illustrative to see how these long cycles play out globally. And we're not necessarily looking at valuation, a pure valuation measurement here, because that's always relative to earnings or asset value, something like that. We're just purely looking at the ratio or what percentage of the total market cap each country or each region is as a percentage of total market cap. So what you see is the United States going back through the early part of last century, so the 1900s up to 1960, we grew and we grew and we grew as a size of the total world economy. Then over the 70s and 80s, we saw Japan surge. Many of you may remember just kind of, I guess, somewhat of fears that were pervasive that they may just, buy up all the U.S. assets, and then they collapsed just as fastly as they grew. And both of those were probably something that the world history had never seen, such a rapid rise and then decline. But over the past couple of decades, we've seen a resurgence in the U.S. becoming a much bigger percentage of the world economy again. And what these cycles provide is an opportunity to either be overweight or underweight international equities or vice versa on the domestic side. So we're still in a world where the United States is growing and appreciating more rapidly than these. But we have to keep in mind that as U.S., particularly large caps here, get expensive, it may not be 2025 or even 2026, but as we go forward through longer cycles, there will be periods where we can take advantage when that pendulum begins to swing back the other way. So that's what we have for you data-wise. We sure appreciate you joining us. As always, we'll give you a reminder. If we can be of value, please give us a call. If there's any question we can help you with, 800-928-4001, or scan the QR code and book it electronically. Thanks again and have a great weekend.